Good day, everyone. Well, both the CPI and PPI numbers came in under estimates across the board, and so in consequence, stock markets have bounced, the dollar has dropped, and the 10-year Treasury bond yields have clearly broken their uptrend. CME Fed futures, in consequence, are pricing in a 50 basis point hike in December and then 225 hikes at their first two meetings next year, and that would bring the terminal rate to 475 to 500 basis points. But today, the Fed's Bullard suggested that he sees terminal rates between 5 to 7% as the CPI is far from the Fed's 2% target. So while CPI may have peaked, Goldman Sachs thinks inflation will remain stubbornly high, and historically that has been the case. And so they expect a terminal rate substantially higher than 475 to 500. As they think the Fed will have to hike rates in 25 basis point increments, well past their first two hikes in 2023. So it's therefore highly unlikely that this current bounce is anything more than one of the dead bat varieties, unless, as I talked about in a prior piece, QE light becomes an enduring factor, which could result in extended, sloppy, sideways market action. Now, the level of debt remains massive as the QE bubble slowly unwinds. So as interest rates get hiked, the amount of capital needed to service the debt has been and will continue to be printed in the form of this QE light. And this is also being practiced by other central banks, first by the Bank of England, as was noted the other week. Now, alternatively, if the Fed starts to print large sums once again, and that would be only due to another black swan event, such as the one we saw as a result of the post-2008 financial meltdown and the COVID pandemic in 2020, we would likely see a new bull market begin. The capital has to go somewhere. But this really only applies to the black swan where the Fed is forced to print trillions once again. Now, we do have some indications that some printing could be spurred by the lack of Treasury liquidity, which has deteriorated significantly. Despite the massive Treasury market, these days, if you're trying to buy even $100 million in bonds, that can be difficult because major countries such as Japan and China are stepping back while the Fed continues to tighten the money supply. And debt delinquency is another factor that continues to spike higher as well, which would be another factor that could force the Fed's hand to start printing again. But even if we don't get such a flood of money printing, we've seen in prior bear markets, such as in 2000 to 2002 or 1930 to 32, how bounces can run for many weeks before the downtrend resumes. And when you look at the monthly chart that's shown right now, and you go back to 2008 when QE began, and more or less ran through late 2021 with only minor interruptions, we're still a long way from those levels. And you can also contrast this to the 2000 to 2002 bear, when the NASDAQ lost 78% and it retraced 5 years worth of gains, which represented much of the dot-com boom, which was launched in 1996 when Netscape had its IPO. Now, in the present bear market, we've only retraced about 1.5 years worth of gains from the decade-plus QE bubble. So, it really started in late 2008. So, yeah, we're looking at like 14 years worth of QE that needs to be unwound. So it seems that we're going to have more selling ahead with a continuation of the downtrend, notwithstanding some sharp bounces or a black swan-induced money printing party. And for historical references, if you look at the 1930 to 32 bear, it retraced all of its gains made during the Roaring '20s bull and then some as the bubble was unwound. Over in crypto, all markets point, metrics rather, point to this being the bottom if and only if we were in a macro bull environment. But in actuality, we're in the worst macro environment seen in this long-term debt cycle, which typically spans 75 to 100 years. So in consequence, all the metrics and stats one wants to conjure up using prior bottoms as examples carry far less weight than what the Fed will do next. And the saying, don't fight the Fed, has never been more true than this year. Gil, how are you seeing everything?
Yeah, I think the Fed heads the last few days, they're all coming out and confirming that they're not done raising rates, and they have to get the peak rate probably will be 5 to 7%. So they're still a ways from that. I think it's kind of bizarre, and I actually tweeted about this yesterday, that the Fed heads talk about stepping down to a 50 bip rate hike, and I just think back, in my experience, 50 bips was a pretty good size rate hike, and now the market takes it as slowing.
All relative, right?
I mean, you can't make this stuff up. It's like this. It's just points out how surreal this market is, how bizarre it is, how unique the underlying conditions are, and I think that creates the potential for all sorts of unknowns, unintended consequences, black swans, whatever you want to call them. And we've seen a couple, the FTX debacle, and then the other day when you had what were really Ukrainian missiles landing in Poland, but initially being passed off as Russian missiles. So, of course, World War III is about to start. But that's also another area where you have instability in the global political realm that can create black swans for the market. Anyways, on a stock basis, you have this follow-through day, I don't know, that occurred many moons ago, but really it was just a big undercut and rally. We saw that, and we knew that at the time that you were in position to try and stage a rally, and that's what you've done. The Dow has been the leading index, so you have 30 stocks, a very narrow group of stocks basically leading the rally, and now we're back up testing the mid-August high. It's like, okay, so that's a typical bear market rally to me. There's really nothing here that strikes me as being of the stuff of a glorious new bull market phase. So here we have a pullback today into the 10-day line. You get a little doji in there on the candlestick, and that's where the Dow is. Meanwhile, the NASDAQ actually lags quite a bit. Even though it has, regained the June lows, which it was pushing through a week ago until the CPI number turned everything around, it's now heading for the 50-day line. So that'll be an interesting test when we get there and see where we go. But I think with the Fed confirming that they're still raising rates, there has been no Fed pivot. Unless the market sees something the Fed doesn't, which is a possibility, because as I said, underlying conditions are so bizarre and unique these days that anything can happen at any time. So the Fed could be forced into a situation where they suddenly have to turn on the fire hose of liquidity and douse everything down just to stop a big fire that might suddenly break out, either as a result of the crypto crisis, as a result of so many financial institutions and other areas of the economy being highly leveraged. So you get all that working, to create some interesting unintended consequences if and when they arise. And I think a lot of them we may not even know about right now. So in any case, that's what I see going on here. If you look at the NASDAQ rally, you're in this little uptrend channel, but you're kind of dropping back to the bottom of it. It's not that much in the grand scheme of things, because we can look at a weekly chart of the Qs as a surrogate. And you see where we're at. You're just kind of in this big downward trend channel. So, I don't see any confirmed rally, even though you get this so-called follow-through day. But you got to remember, follow-through days are so 1990s, because we're not in an era where mutual funds are the primary institutional component out there. A lot of it's just algos trading various program strategies. You got algos running ETFs, and there are tons and tons of ETFs. So you'll often get weird rebalancings. That's where you get some of these. If you have a hard sell-off, and the next day you might see a bounce at the open, that's because some of the ETFs could be having to reweight, and so they got to come in and buy stock because prices have declined, so they got to reweight by buying more, and that creates a temporary buying pressure, and I think that creates some of the volatility today. But you got that, and you've got corporate buyouts, which are starting again. And so there are a lot of other components to the institutional accumulation side of the equation. And that's why you have bizarre things occurring. And it's also why follow-through days, in my view, are about as useless as they've ever been. And, the idea then is you buy follow-through and then you buy breakout and, you live happily ever after. But, I mean, here's one of the leading stocks, Albemarle, breaking out a couple of weeks ago, less than that. Let's say last week, early in the week. You run up a little bit. I don't know what you get here. What do you get? 15, 16, 17%, something like that. Maybe less than that. But, then you fail. And then you bounce off the 50-day line. That would have been Tuesday. And then yesterday, you reverse back through the 20-day line. So that now is turning into a late-stage failed base in progress. And that was a short entry right there. It's a little tricky, you can see, because it fails on a gap down. So obviously that's a high velocity move, a pretty good distance, okay? So you have to think it's going to bounce there, and then you just watch, comes into the 10-day and the 20-day, and then that gives you an entry. So if you're giving it, a couple of percent as your stop, you're kind of in the range of the 10 and the 20 more or less. Well, closer to the 10 yesterday and the highs here. So once you get through the 20-day line, then, it's breaking lower. And then today we gapped lower and through the 50-day line. So now it's really confirming as a late-stage failed base, because it is right now. There's your late-stage base, and there's your failure, and it's heading lower. And that's all you know for sure. But you have several short sale entry triggers on the way down. And that's that, so that's where a breakout gets you these days. And you look at some of the other lithiums. Of course, lithiums were supposedly the leading area of the market. You look at something like Piedmont Lithium. You have a failed breakout last Friday, and that was basically a double top short sale entry. Now, one of the reasons it's difficult to put out any short sale alerts is because it's hard to determine whether we're going to start a new straight trend down, or whether some of these short sale setups will work for, say, 2 to 4 days, and then that's it. So we don't know. It's hard to determine whether you're in, like Chris was saying, you could be in a choppy environment for a while, so that doesn't necessarily mean that you're suddenly going to see everything break to new lows. You could, okay? And I think if you're a short seller, it's very hard for me to tell somebody, oh yeah, here's a short sale setup, enter here, don't think anymore. Because you have to be thinking constantly. And so I think the best venue for discussing the short side is these very webinars, because I can get into more detail and I can just kind of discuss the nuances regarding the whole process of shorting in such a screwed up market. You know what I'm saying? Anyways, you got the failure here, you got a trigger here and here and here. I mean, you can be working this thing all the way down. So that's another one. Then you have Livent. The thing about this one is I constantly want to make the symbol LVNT, but instead it's LTHM. Take all the vowels out of lithium, that's what you get. I want to take all the vowels out of Livent and create the symbol. So not sure what's going on with the old brain there, but we'll have to look into that later. In any case, you're breaking the lower lows on this puppy. You did approach this double top high, but you could also use this peak as an entry trigger. That's a possibility, because you're looking for reference points. Then you got another double top in here on this peak right there. And then you got a trigger at the 10, the 20, and the 50 all at once. 3 days ago, or 2 days ago, I guess that would have been Tuesday. And you're going lower. And that's also a late stage failed base without the breakout. But you can see that you were getting some, if you want to try and buy these things, maybe you're better off trying to do the little moving average undercut and rally where it shakes out just a little bit, the little teaser shakeout at the 200-day line. Try buying it there if you're watching it coming down. But then that's the key thing. You got to be watching them like a hawk. And what that means generally is operating from a very small list of stocks every day that you can watch closely. So, last week I was just watching things like Anglo Gold Ashanti, Goldfields, First Majestic, because these are what we're moving. And they started gapping up a week before the CPI came out. So by the time the CPI came out last Thursday, these things were already trucking higher. And you look at some of these, I mean, from this Bible gap up here, and again, to me, it's a swing trading type of thing. You don't know whether it's going to work. It's a very uncertain environment. So, we teach these setups in these webinars, in our books, everywhere else. And I think if anyone's followed us for any period of time, then they should be able to recognize these on their own. If not, we're not really doing our job. But I think for the most part, you really have to understand what you're doing. So I don't like some newbie who's just signed up for the website and they think they're going to be told what to do, because most people are programmed to basically want someone to tell them what to do. People don't like to think for themselves. At least that's been my experience. And I think when you're shorting in this environment, if you can't think for yourself, say goodbye to your head. That's all I have to say. Anyways, so we got Goldfields now pulling in. Okay, so this from here to here is a 55% run, and it occurs in 5 days? Okay, so now you got to think about this. So playing this thing last week, I'm watching it just shoot higher. And I got to admit, it's kind of pissing me off on the way down, because I'm looking at this. Okay, I'm going to sell some there, and then it goes, just to piss me off, goes higher, and you sell some there, and then finally it starts to break down. Then you end up blowing the rest of it out there. But you make a nice gain. And that type of gain, even if it's only 30%, so a little over half of the entire move, to get that in just 5 days, in this market, a lot of stocks can take several weeks to do that. So you have to keep things in perspective in terms of what this market is going to give you. And sometimes it gives you more, sometimes it gives you less. And again, that's why I say it's impossible to put out any coherent series of reports. I'm glad that we did put out, these are kind of textbook though. You had a nice shakeout in the PSLV at the 50-day line, so that worked. Okay, and then we had the more obvious one, I think, there for most people would be the undercut and rally, which goes to these two lows, and then boom, you get a very nice move. So you're going from around 1250 to 1360, 7-8%. If you're using something like, because we like to use the AGQ, which is a 3x leverage silver. So that move on the shakeout, and I actually prefer this over buying SLV or PSLV if I'm playing it for a trade. Okay, PSLV, if you want to actually own silver, that might be your best shot, since the prospectus says that it is backed 1-for-1 by physical silver. So, that's a different issue altogether. If you're just trying to trade the price move, I want a leveraged vehicle to do it with, then this works pretty well. So from here, you're going, say, from 21 up to 27.5. So, what is that? 30% basically. And that's not bad in just about 8 days. So that's not a bad move at all. So I'm glad that we at least got that out, because the other ones were kind of touch and go. This one, I have to admit, trying to play it, my instinct initially was, if you can buy the Bible gap up, now you run up to these highs, okay, and it reverses back through this high here. So intraday, it becomes a short. So I'm shorting it. And then it comes in and it holds, and you get a scalp out of it if you're watching the 620 chart. The next day it holds tight, and I just decided to load the boat at that point. And in here, the company Yamana Gold, which they were supposed to buy out, announced that they were rejecting their offer in favor of a joint offer from Agnico Eagle Mines and Pan American Silver. I thought that was interesting, a silver miner and a gold miner teaming up to buy a gold miner. Okay. In any case, I hope that works out for them, because it didn't work out for Goldfields, because they tanked from 1220 down to about 937 back in May when the deal was announced. And so, I theorize even loudly on Twitter, for those of you who follow me, this is back in May. This was where on the weekly chart where they announced the buyout of Yamana, and boom, it just broke down. And I theorize it'll probably just go right back to where it was trading when the deal was announced, especially given the move already occurring off the lows in gold and silver. So that worked out pretty well. But what I'm trying to give everyone a sense of, and I'm not trying to brag about some great trade I had, because I can show you this is a great trade, and for every one of these, I've got probably 10 other little nickel and dime losses that have pockmarked my trading whatever, I don't know, my trading head. In any case, these are coming in. I'm just going to sit back and let them play out. If in fact the Fed is going to pivot, okay, then the possibilities are that they'll just do it. They'll, out of the blue one day, they'll say, "Oh no, we were wrong. We're going to start lowering rates again." or we're going to stop raising rates. And then probably everything shoots higher. The dollar tanks, gold, silver run higher, stocks run higher, Ponzi scheme stocks run higher, cryptos run higher. Everything runs higher if that happens. If not, then the market's in a situation where it's trying to figure out when and if the Fed is going to start. Well, first stopping and ending the rate increases, and then letting them, quote, do their work, as they like to say. Or whether the Fed does something else, like raises their inflation target from 2%, as they have it currently, up to 4%, which is a possibility. If they did that, that might be construed as quasi-QE, and so that could trigger a big rally. So, you've got that on the other side of the equation. So, and just as you can get big moves when that theory kicks in, you can get nice short sale entries in things when they don't work out on the breakouts and whatnot, and the market's coming in on this rally that maybe, has run its course. We'll find out. So very much a two-sided market at different times, and you're basically swing trading it, which is all to get back to my original point, which is that it's very difficult to put out reports in this market. We had someone come in, email us, where's the focus list? I'm looking for the focus list. I want stocks to buy. It's like, well, bozo, this is a bear market. We don't have a focus list of stocks to buy because there's nothing to buy. Some people don't really understand that one, Chris. I don't know. You probably have noticed it. It's
the same. The crypto picks list. That I have had no names on that list since I took the last 3 off on in early February of this year. Took most of them off in January. So pocketed profits in most all cases, except for the last few that were added toward the tail end of the bull market. The thing is that people have been just absolutely devastated this year, trying to play the long side or trying to catch the bounce, or all the talking heads saying, oh, this is the low, this is the ultimate low, and they've been saying it like a broken record all year long, and they're still saying it. They still are saying it today.
Yeah.
On the basis of an improved CPI, lower inflation, just all the stuff that it's almost like they don't get the bigger macro picture. They certainly didn't earlier this year or late last year when we first made mention that, Powell looks like he's going to put on his hawkish cap now for the first time since the end of 2018. So, 2019, 2020, 2021, Powell was very dovish. That's just a song and dance. Then in November, he removed the word transitory, and then all hell broke loose after that point with all these rate hikes. And I think that the rate hikes, the thing is, if we get a black swan, he's going to be forced to, reduce rates again. And depending on the magnitude of the money printing, it'll determine whether we are off to the races again or maybe not. If it's not enough money, if it's not enough liquidity, then I think there's a lot of countervailing forces that potentially keep the market kind of trapped, like we've seen before. And that's a very difficult environment to trade in. We saw this in the 70s too. Part of the 70s were like that. After big bear markets, you didn't get these nice bull markets. I remember Bill O'Neill telling me about how it was a really dry time, a really tough time to make progress in either direction. I know he had said he tried to short the market and ultimately did not make much progress and actually lost a little bit of money. Even in a bad environment, it can be difficult to short. And I would say, crypto is worse because it's far more volatile. And, crypto in this market, my account has gone from super winning earlier this year, nailing the right shorts, to giving back a bit of profit because I was, everything looked so bad, but then shorts get squeezed when everyone's piling in on the short side. So, and I was willing to give back and take the risk because if all hell broke loose, then I'd be up even more. But, it's all calculated risks, and I'm, still up double digits for the year, going short. So I'm very pleased with that, but we'll see. We'll see what happens. If we get one more break to the downside, I think that'll be, the last remaining time to get short, at least in crypto. But remains to be seen. So, at any rate.
Yeah, I think if we do get another leg to lower lows and you get a huge climactic panic low, and maybe there's a few black swans that hit, you can be long try to be long volatility if you can catch it. It's been coming down, which shows you how complacent everyone is getting now. So something to keep an eye on. In fact, what are we doing today? I do actually have a little of this right now. And I'm looking for my 620 chart. I know it's in here somewhere. Must have lost it. There he is. Here we go. Yeah, so you did have a cross under 9. You could see that. So there it was, actually. You might have heard my order thing go off a little while ago. Anyways, any questions? So we have SMH. Yeah, the SMH 2 days ago was at the 200-day line. So, you know, what you're going to notice is that groups will tend to correlate very closely. Semiconductors are one such group. So you look at AMD, you look at AMAT, they're all moving together. They all top together. Some of them, they have concrete short sale entries like AMAT at the 200-day line yesterday. But you'll see basically the same. They're tracking together, basically. They're in different positions on their charts in some cases. So look like Avago or Broadcom, rather, as opposed to like AMAT, which rolls back below its 200-day line. This one doesn't quite make it up to the 200-day line before reversing. And my guess is if we look at the weekly chart, it bumped right in. Yeah, you see how it bumped right into the 40-week line here. So you got to watch both moving averages, because a lot of times when they fall short on the daily, they will actually bump into it on the weekly. So that's kind of what you would use as your reference if you want to short it. So if you notice like at 534, then that would be a reasonable covering guide, which for a $500 stock, you know, $5 is 1%. So that's pretty tight. In any case, they all correlate. Let's just come up from the other way. So we'll do MU. You can see, I think MU is going to go a lot lower eventually. All they make are memory trips, you know, DRAM and RAM, I guess, and it's a commodity, you know, and this thing sells at what, 6 times trailing 12. I could see it selling at 1 times. There's no real growth here. Western Digital is another one rolling over, but again, I'm just showing you how these are correlating. These are some of the worst ones. Qualcomm, another one here. Trying to find support at the 50-day line, but they tend to correlate. So when I see the SMH at the 200-day line, what do? You buy the SOX-S, and you get a nice little bounce from like 30 to 38, maybe 31, 38. I actually didn't buy it, but that's how I would play it. So it's that's how it worked. But you know, what are you getting now? Excuse me. You're getting a little a bounce, and we'll see where it goes. If we watch it on the 620 chart today, what do we see? You just got a long entry signal here at about, let's see, that's at about 36, say. So you're pulling right back on top of it here, but rolling back. We'll see how this plays out. I think you're going to go lower as the day wears on, but we'll see. What I think is going on is the market and people who are scrambling in late, you know, that would be all the IB dweebs, you know, buying breakouts, you know, and stuff like this. That doesn't work. And so you get money coming in late, and that might create a little cushion here or a bid to sell into, and then they just clean it out, vacuum it up, and everything heads lower. We'll see. But if you look at individual stocks, you'll see that a lot of them have been down for 3 or 4 days. So in that sense, there's some extension on the downside that might need to be worked off, and that might be also a factor as to why the market isn't blowing apart. The Dow is finding support at the 10-day line. The NASDAQ coming into the 50. The S&P is, let's see, coming into the 10-day line as well. So that could present near-term support on a temporary basis or possibly on a longer-term basis. But again, I think the market only sustains a rally here if it has figured out before the Fed that the Fed is going to be pivoting sooner than later, the same exact way that it figured out that the Fed was going to be raising interest rates long before the Fed figured out that they had to be raising interest rates, because rates started to turn in August of 2020, and they continued higher and broke out and just continued to move higher the whole way. So rates started rising before the Fed started raising them. Anyways, let's go over and check out some other questions. Article says FTX spoofed the market in BT. Okay, well, that's nice. No other questions, really. Let's look at, Cisco is moving today, but what do you notice here? You got a little double top thing going on here. Let me blow it up so you can really see it. And there it is. So you got this peak here. You opened, I think just below it, pushed above it, in reverse. That triggers a double top short sale entry. And now you're rolling in. Okay. The other company that reported earnings last night, that's a big one, is NVIDIA. And here you are. It doesn't really know what it's doing right now. But in the grand scheme of things, that's where it is. So, don't get too excited. And in a real bull market, you would see a lot more things setting up, not things just bouncing off their lows. Although they are tradable using OWL techniques, using all the methods that we talk about. Bottom fishing pocket pivots, bottom fishing viable gap ups. Those worked really, really well 3 Thursdays ago now, I should say. In the precious metals sector, like the pocket pivots as well, the undercut and rally, all of that stuff works as a swing trading entry. You don't know how long it's going to take you, but if you can get, like I showed you, part of a 55% move in 5 days in something like Goldfields, GFI, you're doing pretty well. And that's basically what you're doing. So don't get too excited. What else is going on? I noticed Walmart was up big. Okay, that's where they are. They're not quite up to their highs. It looks like a cup with handle breakout. And I bet you it fails. TJX is another one that's been moving higher. Retailers, notice how you're in double top land, okay? So what's happened now? If we take this peak up here at 77.33, well, you traded above it earlier today. You can see that. And so 77.33. And you're now trading at 76.29. So you've triggered a double top short sale entry using that 77.33 high as your covering guide. Pretty easy. That's about 1.5% higher. So, there you go. That's where a lot of breakouts go to die. They just become double tops. So let's see what else. I know there's some other earnings reports in the retail area. Let me see here. We'll go this way. So yeah, Macy's is trying to rally. Kind of in double top land there. It hasn't really reversed yet. You might want to watch that. Ross Stores in double top land, potentially. Williams-Sonoma just gapped down. Foot Locker gapped down after earnings. Yeah, so there's nothing really. Here's Best Buy. And Best Buy, I believe, is tanking with Target, right? Was it Target that reported yesterday and blew up? Yeah. So there's Target. And it's trying to rally back into the 50-day line. Maybe it becomes a short there, and that's what you're looking at. Somebody's asking about Wolfspeed, the semiconductor for the electric vehicle industry. This is a short at the 200-day line yesterday. Now it is spinning around the 20-day line. Oh, you know the lingo, right? Right, Chris? Apparently, not you, Chris, but the Chris asking the question. Yeah, it's spinning around the 20-day line, and we'll see if that doesn't turn out to play or doesn't play out as another short sale entry. You might have gotten faked out today, but another thing to keep in mind when you're shorting is the day that the market rolls over, and really the market started to stall out on Tuesday, right? So a lot of these things, you'll see a lot of stocks ran into moving average resistance, some price resistance, double top resistance on Tuesday, and some yesterday. But a lot more on Tuesday, and they've come down since then. And so, once you get to, so if you got a 65-day on your chart, you can see that for me, I could use that as a short sale entry, and I use it sometimes. Then you get the 200-day line yesterday. Okay, now by the time you get down to the 20-day line, you've triggered 2 short sale entries, at least in my book, one at the 65, one at the 200. Now you're coming down to the 20-day line. If you're trying to come in there, you can be late. It might swing around for a little bit because it will first try to find support at that moving average, even if it shakes out along the line. So you got to remember that, okay? So don't get too eager to keep shorting something. And if you get it from 95 down to 87, what are you making? 7-8% pretty quickly. You can take some of that, I think. Anyways, any other questions? That's all I've got, really. I think if you're going to get short, if you're a short seller who understands what to look for, then you probably saw some things to short 2 to 3 days ago, at least 2. and maybe even yesterday. And some of these you may continue to work depending on what the market does now. But the market gap down this morning. You're seeing the Dow and the S&P trying to find support at the 10-day line. The Nasdaq's coming into the 50-day. The bottom line is the short side was beckoning you on Tuesday. Now you're down for 3 days, and it gets a little more obvious on the indexes. So you kind of got to play things close to the vest here at this point. Maybe take some profits and hang out and see where things go, because we still got well more than half the day to go. Anyways, that's all I've got. Thanks for showing up, you guys. We will talk to you next week. Take care.
So long, everyone.